So what I told them is, either you need to find out something which is working best, or you need to analyze and see what is happening with that, and you need to keep on optimizing your strategy. Because if you're not, if you're using something which is not back tested properly and all, then you need to make sure that your strategy works in most of the market, and when it gives the drawdown, you need to have a clear idea as to how much will be the drawdown. But the discretionary trader who just do the selling or buying whatever, if there is a period wherein it is not working, just stay away from the market. And when the market starts working, you can get back into the market and you can start making money. So as a discretionary trader, most of the time, market may not be favorable to you. But when the market is favorable to you, you can make a killing. And many people know that. Like yesterday, Jitendra was saying, trading is a business where you get paid for being disciplined. This is a part of discipline. There could be certain times when you can make hell lot of money in certain setups, which works absolutely fine. Those times, go aggressive and be active in the market. But certain times, you know that your strategy is not going to work. It is not giving you enough risk reward on your trades. Those times, stay away or scale down. Scale down completely. Maybe if you're trading with the 1000 quantity usually, trade with 100 quantity. And when the market becomes favorable, again scale back to 1000 quantity. So you need to do something like that for continuously staying in the market. And FOMO is a problem. So for cheating the FOMO only, I do a lot of things like strangle selling and be in the trade with smaller trades and all. I do that and I stay in the market. And my ego will be satisfied with a smaller profit. But I will not, even if the trade doesn't work or setup doesn't work, I will not lose big. There are certain setup which could be, probability will be lower, but I don't, means I may not feel to skip that setup. Those times I take these kind of trades. I go far OTM and sell some options and stay there, and whatever 1 or 2 or 5 or 10 points what I get, that will at least satisfy my ego. And position sizing will give you the holding capacity. See, many people say, I take a trade, I'm not able to hold it. See, if their capacity is to take 1000 quantity, if they take the trade with the entire 1000 quantity, and if they're not able to ride the profit beyond 10, 20, 30 points, it doesn't make sense. Scale down to maybe 200 points, 200 quantity. Then you will have the more presence of mind, more control on your psychology to ride the profit. Because when you take a trade, it has to be absolutely, you have to be absolutely comfortable with the position. Only then you will be able to ride the profit and see your losses and be cool, only when your position is well within your control. And that is the one of the most underrated thing in the market. People talk about it, most people talk about it, but most people do overtrade and spoil their psychology by doing the overtrading. And unless something disturbing the current trend, I would like to trade in favor of the prevailing trend and would use every move against the trend as a trading opportunity. See, most of the time, if the market is continuously moving up, right now the market is moving up. So most of the time, the move against the prevailing trend, I use it as a opportunity to buy. Because people say buy on dip. And when the dip comes in, they get afraid and they sell it. And when the market reverses, they book loss, right? That's what happens. And when the market gives the dip and I buy, most of the people around me, they ask me, what is the guarantee that you have that the market will come back up? Market is making higher highs every day, and one day morning market gave a good dip, and I buy calls. First of all, people will ask me, why are you buying calls when the market is falling? I say, uh, did Bank Nifty hit all-time high yesterday? They say yes. Did it hit the day before yesterday? They say yes. And did it hit prior to that? They say yes. Then what is the trend? It is bullish. What kind of market it is? It is buy on dip. What did we get? We got the dip. Then we should buy the dip, right? That is the funda. Then what is the guarantee that you have? The market will come back up. I say I don't have any guarantee. The only guarantee that I have in this kind of setup, if I keep doing the same thing for 10 times, at least 7 to 8 times it works. 2 to 3 times it doesn't work. So the time that I buy today, that can be one of those 2 to 3 times or one of those 7 to 8 times, right? It can be anything. I'm prepared for that. If it loses, it loses. It's a part of the trading. You can't trade on the guarantee always. Certain times it will move in your favor, certain times it move against you. The only thing that you need to be aware is you have to have the higher probability and risk reward in your favor. That's it. That is the end of the discussion. And major things that can disrupt the trend is any sudden changes in any major global market, overbought or oversold market, any news, events or triggers. These are the things that can disturb the current trend. If none of such things are present, I would always try to consider that the market is going to continue with the prevailing trend. And it works most of the time. 70 to 80% of the time it works. 20 to 30% percent of the time it doesn't work and I book loss. I'm okay for that. Okay, I think I have one more slide. After that we'll go into the Q&A. So this slide I have put it because many people frequently ask me what are the books that help you to become a better trader. So when I was becoming a trader, there was no course or anything. I never knew anybody who was teaching the trading. There was no YouTube or anything. So I was reading the books and learning the trading. So not just about the trade per se, you need to convert yourself as a trader. It is not that, okay, you learn some setup and do trading. No, that is not going to give you the long-term growth. If you want to become a trader, you need to mold yourself as a trader. For that, these are the books that help me. And if you ask for a book recommendation to anybody, 90% of the time, the first book that comes out of their mouth will be Trading in the Zone by Mark Douglas. So that's a trading psychology book. You can read that as many times as you want. I read multiple times, but even now when I get time, I go and refer that book. Amazing book. It will help you to think probabilistically. That is most important in the stock market. And the Market Wizard series by Jack D. Schwager. And those are the interviews with the world's greatest traders. You can learn a lot from that. It is like a story and it is like, the audiobook is also available. It is amazing. You can see how they see the market, how they make money. They are also not sharing any holy grail. They are just telling how they evolved as a trader. You can learn a lot of things from the winning traders, right? And the next one is High Probability Trading by Marshall Link. So there are a lot of things that I do right now is being shared in that book. So that is the reason I like that book. So it's a very good book. And One Good Trade by Mike Belfoyer. That is also a similar kind of thing. He is also sharing some technique, setups and psychology and money management, all of those things. So they both do the same thing. And one book I regret not reading earlier is Technical Analysis of the Financial Market by John J. Murphy. I should have read that book long back. I read that book maybe a few months back only. Already I completed 2 times, and third time I'm planning to read the book as a paper book. First 2 times I listened to the audio book. Next time I'll buy the paper book and I'll sit and read every day at least few pages as a syllabus, and I will start studying that. Because this covers almost every, not exactly every, but almost every technical indicators and technical analysis and the story behind it, the psychology behind the technical indicator. All of that is perfectly explained here. And I think he's one of the founders or one of the leaders in the CMT, Chartered Market Technicians, the technical analysis. There is a group, right? You know, Vishal Mehta and all. He's heading India, and this guy is either founder, one of the founders, or he's heading globally, something like that. So amazing book. You can anybody who wants to learn the technical analysis, this can be the best book that you can refer for learning the technical analysis. And Thinking Fast and Slow, Daniel Kahneman. It's a Nobel Prize winning book. And that is again completely behavioral economics book. Not trading related, but your behavior economics. In a financial market, certain times with loss, with profit, with probability, with risk reward, how you behave, or why you behave in certain way, this book will make you realize that that can mold you as a trader. It is little hard to read that book. I read multiple times. Still, there are a lot of things that I never understood, and I still have to read. And each time I read, I get more and more points. And how I made $2 million in the stock market, Nicholas Darvers. That is a book written long ago, maybe before even I born into the world, that book was written. But he talks about lot of, what to say, the crux of the speculation or crux of the trading, which is still valid. So it is good, especially for those who are trading in the stocks or investing in the stocks. This will definitely help you. Not the derivative traders also can make use of it, but mostly the people who trade or invest in the stocks, this can definitely help you. And one unique book, What I Learned Losing $1 Million by Jim Paul. So I think this is the one and only book I heard about losing the money and the learning. There are a lot of books sharing the winning strategies, but this is the only book I saw somebody sharing the learning from the losing money. And he also says there are thousands of ways to make money in the market, but there are only few ways to lose the money in the market. That's what he explains here in this book. A good read. And I think yesterday a couple of people were talking about Jesse Livermore. This is his story, Reminiscence of a Stock Operator, and it is written by Edwin Lefferway. And I think if you read that book, every sentence in that book is a quote. He is the person who said, "It is not my trading that made me rich, it is my sitting that made me rich." Means people do analysis, take trade, but when the trade starts working, they exit it. They are not able to write the profit. You write the profit by sitting on the trade. That is where the big money is made. You take a trade for 1 lakh rupees and it gives you 10% return. It comes to 1 lakh 10,000 or 10,000 rupees profit. Most people take it. But if the trade works, we need to sit on it. We need to sit on the trade as long as the trade works. Let it be 1 lakh to 2 lakh, 3 lakh, 5 lakh, 10 lakh or 1 million. You need to sit on that. That is how the big money is made. You heard about Warren Buffett, Rakesh Jhunjhunwala and all, right? How did those people make money? The stocks they bought for the penny stocks they bought, it went to 100. Maybe I don't know the exact stock name and the price. Maybe the stocks that they bought for 4 to 5 rupees, it went to 10, 20, 40, 50, 100, even 1000. They must be still holding it, right? That is how they became rich. It is their sitting that made them rich, not their trading. They identified the right stock or right trade, they sit on it, and until that doesn't work. That is how you make the big money. That's what he says. That is just one example or one thing that he said, but he is probably the greatest trader ever lived in this world, except the later part of his life. And The Psychology of Money by Morgan Housel. So it teaches about about money, and he talks about the psychology of money, how much money you need. Like Sharik was saying the other day, before you devise a strategy, you need to know how much you need, right? So those things are perfectly described in Psychology of Money, not about trading, but about life, about the money management. Complete psychology of money, how to handle money psychologically, not like spending. So that's a good book. And one book completely out of syllabus, Millionaire Fastlane by M.J. DeMarco. He is an entrepreneur. He became rich by working hard, but he became rich very quickly. So what he says is, quick money is possible in this world, but easy money is not possible. There are millions of people who became millionaires or billionaires very quickly, but it is not easy anytime. Maybe Dhirubhai Ambani or Adani or Elon Musk, those people became filthy rich very quickly, right? But was that easy? It is not easy. So quick money is possible in this world, but easy money is not possible. But you need to identify what are the areas where you can make the quick money. So he's explaining pretty well about those things. So these are the book recommendations that I have about. And before going into Q&A, just one more thing. And these are the ways to connect with me. And I have a mentorship program, but we do rarely, we don't do frequent courses and all. Once in a while we take courses because I don't want to disrupt my trading just because of the mentorship. So, but we do 2 days live interaction and course, then 4 weeks live trading. I trade with the mentoring team. That is what we do. But currently there is no slot. But in between we open once in a while, once in a quarter and all, we open a batch. And Twitter, this is my handle. And Telegram, be careful. If any Telegram channel is putting in my name and asking for money, don't give it because I don't have any Telegram paid services, no tip services, no crypto services. With my photo and name, there are many, not just mine. All the traders will have so many fake accounts. I also have 2, 3 because since I am not that famous, I don't have too many, but at least 2, 3 are there. So don't fall into that trap. So I think that's it. So any questions before winding up? Yeah.
I have multiple questions. First is time.
Can you please use the mic?
Hello.
Ah,
So I have multiple questions.
okay, sure.
One is regarding the time frame you are using.
Huh?
Time frame you are using.
Time frame,
It's
yes.
3 minutes.
Ah,
Yes. Any there specific reason for selecting 3 minutes, or
yes.
it is just it is in your comfort zone? That's why.
Yes. So there is a reason why I use the 3-minute chart. So not just 3 minutes. I look at all the time frame. I trickle down from the monthly chart. Morning I look at the monthly chart, weekly chart, daily chart, hourly chart. Then I look at 3 minutes and 1 minute. So while trading, mostly I use either 1 minute or 3 minutes. The reason for 3 minutes is maybe it is a childish reason, is what most people might feel. But so I will open the chart. So this is a 3-minute chart. So this is yesterday. See, this is yesterday's chart from here to here. It perfectly fits into my computer without getting clustered, without becoming so big, so that I can comfortably see the pattern. Because like I said, I'm not using any indicator, I'm using the pattern. So I can recognize the pattern very quickly looking at the 3-minute chart. And what I do is, I do take the screenshot of everyday chart from 2019 onwards I started. I have in 2018 also I have few months. Then I organize the chart Monday, Tuesday, Wednesday, Thursday, Friday. So all these are Thursdays, all these are Mondays, all these are Tuesday, Wednesday, Thursday. So I keep the chart organized here. While organizing, the same funda, the 3-minute chart perfectly fit into the screen. I can take it and develop and see what happens, and I can see the similarity in this thing. See, these kind of similarities I can see, and I can see how well it is. It can help me in the trading. So because of all reason, I predominantly look at the 3-minute chart, and I make the trading journal also here. Let's say there's a specific day, some wild price action or news-based action. I mark it as yellow, highlight it as yellow. Under that, I put a note. What all things happened that day, what was the specific reason, what all are the new learnings on that particular day. And I keep referring that once in a while so that I don't forget, and when it happens next time, that will help me to take the right position or right trade.
Second question is the selection of the strike price.
Okay.
Just I put an example. If the bank nifty is at 42,300 and my bias is bullish, so I will sell. I have two options: either sell put options at 42,000,
Okay.
because that is very liquid strike and it has huge OI. Or second option is below 42,000.
Okay.
So how do you select it? strike prices?
See, I do have the methodology, but that is very long answer. It is very difficult to explain in a short time frame. But I'll give you the idea so that you can go and research in that way and you can develop your own strategy. So what I do is I frequently check the premium. Everybody knows that okay, when the VIX is high, the premium is high. When the VIX is low, the premium is low. That is true. But there is one more thing. There are certain times the VIX may not be the true reflection of the current market move. There are certain times. The market may be moving big, the premium may be low. You must have felt that. So certain times market may be moving very narrow range, but the premium is exorbitantly high. So I keep a very close look at the premium. Over a period of time, I developed that skill of identifying okay, whether the premium is high or low. Because I have been monitoring the premium very closely for over a long period of time, I can recognize that better. May not be perfect, but better than many people. So I can take a call. Let's say I identify that the premium is very high compared to the move. Those days, I prefer to be a seller of options, not the buyer. Those days I aggressively sell option. And certain days if I identify that okay, the overall premium is much lower than what it should be compared to the move that we are getting on a frequent basis, those days I don't sell options. I become a complete buyer. And that is how I decide whether to be a seller or buyer. And if I am a seller, if my conviction is for a good rally, I sell closer put or even ITM put. If my conviction is for a good fall, I sell closer one or ITM. But if my conviction is like a moderate, based on the things that I follow, I go out, depending on the things that I
My
follow.
question is, yes, you told it's correct, but my question is, most of the time we choose high liquid strikes, but there is most OI. But when the market crosses that OI, means crosses that strike, so there is very sudden fall. So we don't get even time to close the position.
Okay.
So it is better to just go 2 to 3 strikes below the this
Highest OI.
highest OI.
You may not get the right risk reward because if you go somewhere below, let's say 42,500 call option has good OI. If you go to the 42,600 call, most of the time, especially on an expired annual premium, will be extremely low. Selling that may not give you the right reward.
Because
Otherwise, you need to devise a strategy based on that, like Sharik does.
okay.
And I don't pay too much of attention to open interest. It is important, but it is not too much importance to me. Important to me. I prefer to create open interest rather than following open interest.
And third question is regarding the ATR.
Huh.
Just for example, suppose the market is, yesterday's market is 18,000 Nifty,
Okay.
and now the ATR is around 150 considering the
180.
VIX.
180.
How?
Approximately 1% is right now the ATR.
180.
Yes.
So from today's market, can you define the levels 18,000 plus 180 on higher side and 18,000 minus 180 on lower side, or from the opening of the next day Nifty levels?
Mostly the range, maybe either yesterday's close or today's high minus 180, or the other way, if you look at the higher side, yesterday's close or the day, today's low plus 180. That way.
Okay.
And don't follow that blindly. That's
Okay.
about just to create a range, just to create a range in your mind.
Okay.
Just to realize, okay, what is the usual move that happens? That's it.
Okay, sir. Thank you, sir.
Thank you. Anything else? Anybody else? Okay, I think so. Thank you, everyone. So let's wind up the session and thank you.